Samit Vartak joins us now. Let's take a conversation forward. Samit, fantastic to have you back. Thank you for joining us. You're a midcap investor, and midcap is where the real route and the real royal is. How are you dealing with this kind of a midcap fall? I mean, are you changing your portfolio strategy? Are you readjusting the risk which you have in your portfolio? How are you dealing with this gut-wrenching midcap fall?
Hi, no pleasure to be here. I think, I mean, mid caps, small caps, typically are more volatile. So they definitely tend to be, um, uh, having much more drawdown. But I don't think this time it's been that bad, compared to what we have seen in 2018 and 19, or even the previous cycles in 2012, 13, or 2008, 9. I think we if you have a reasonably good quality portfolio, typically it hasn't fallen as much, as maybe the indices or the broader markets indicate, right? I think, see, this is a time when you get, it's like a, 2 or 3 year kind of sale period. And many a times, a lot of poor quality companies as well as good quality companies, fall to the same extent. I think this is a time when you get that opportunity to probably improve the quality of your portfolio, because I'm sure there would be few companies who may not be playing out as you thought, and this is a time to replace them with something good. I think one of the mistakes that one needs to avoid, which I've learned through doing it many times, most times new investors think that the stock which has fallen the most is probably the most attractive. Not necessarily. I think this is a time to completely reset your thought process and see which are the stocks which will do well going forward. Forget about how much they are down by, or which are the most beaten stocks in your portfolio. Don't keep on adding on. Don't keep on averaging up into those stocks. Just be neutral and evaluate the portfolio from today's point in time, which you think are the most attractive, and rank them, and just build a portfolio as if you are building a new portfolio with no baggage, from your historical holdings. I think that's, if you do that, at least when the things normalize, you will bounce back the fastest, and you probably will do much better, rather than, adding up to your highly beaten, poor quality stocks.
Let's say Jan 2022 and June 2022, the world has changed. Commodity prices have changed. Interest rates have changed. When these things they change, businesses and underlying valuations also change. Have you changed your top 3 or 5 holdings?
No, we have kept the same holding, because business-wise, when you look at the fundamentals, they are as strong as they were before. Right? I think this is more of a global issue, of which India is facing a collateral damage. So I don't see, just because inflation and interest rates are becoming a big issue in the global developed markets, we will face the same issue. I mean, look at their interest rates, where they were. They were, the 10-year yield was as low as 0.5%, and from there it went up to 3.5%. Whereas we were probably at 5%, and we are now at 7.5%. Right, and we are pretty much used to such interest rates. Corporate India today, probably good quality corporate India pays 7.5%, 8%, 8.5% kind of interest rate. And we are used to paying double-digit kind of interest rate. Inflation for us is typically in that range of 4 to 6%. Today it's at 8%, which is close to the 10-year yield. So it's not that big an impact for us. It's just that we are facing the collateral damage of the world. I think India definitely this time is significantly better position in terms of, look at the corporate debt, almost at the lowest level in India's history. Consumer debt, not much. Indian consumer wasn't pampered with throwaway from the government. So we went through COVID without too much of an help from anyone. And look at even the government financial position. It's not too bad. We are at 90% of GDP, right? Our currency is pretty strong. The demand side isn't bad at all. I think if we went around talking to many companies, because after COVID we got a chance to travel. And ground level situation is not bad at all. It's just, as you said, the PE is taking a beating. And see, I mean, I have even in my last newsletter, I had presented an analysis of the most predictive valuation metric typically is price to book, right? Price to book in 1992 was 10 times, right? And we spent almost, if you look at the Sensex level in 1992 and Sensex level in 2003 and 2004, it was almost the same. So in between, the markets went up and down, but we spent almost 11 years with zero returns. 2007 or 2008 peak, price to book was 6.5. And from then, if you look at 2014, the Sensex level was at the same level. So we spent similar, how much was the price to book was the number of years we spent without really making much, 6.5 years without making money. Our average price to book in the last, 30 years has been about 3.5. Today, we are below 3 times, right? So I think investment is not about certainty. Investment is about probabilities. When you enter at such a point in time, what is the probability that you will make reasonable amount of returns? So if you enter at such valuations, typically you make in a longer term period. Short term, no one can predict. A 2-time price to book can become 1.7 price to book for a week. And it's down. It's going to be down by 15%, right? But it will remain there for maybe a very short period of time. Most of the extreme low multiples remain there for a very short period of time. It's a blip, right? But people do get worried about those blips. I think if you just extend your time horizon a little bit, most often you take the right decisions rather than getting scared because of those blips. So I think today we are not that badly positioned, and I think once we get out of this crisis, globe will realize India has stood out. India is not the same India what we were in 2012-13, what we were in 2007-8, which was heavily leveraged, which was the banking system had huge bad assets on their balance sheet. I think a lot of that has been cleaned up. Even the investor is not as leveraged because the margin requirements are so high that very few investors have leverage.
Sure. Samit, I actually went through your last note where you did talk about as to how price to book is more stable or multiple than PE. And in that same note, you also mentioned that we have at least one bull market every 5 years. Assuming that we are in a bear market right now, is that also going to last 5 years or is it going to be short-lived?
Right. I mean, see, bear markets very difficult to predict. As I said, it depends also on the if your starting P multiple or the price to book multiple is high. I mean, if you started in 2008 peak, you had almost 6 years of bear market, right? Because you didn't make any money, and in inflation terms, you probably lost money. Same thing happened in 1992. Right? So bear markets, how long they will last, I think depends also on your starting point. Right? Today, the starting point isn't that bad, and I mean, just look at the last 10 years. Our Indian market returns haven't been, anything to talk about. Maybe in rupee term they may seem, but in dollar terms they are way below, our long-term average. And look at the U.S. returns; they have been probably the best, last 12, 13 years that they have seen. And so probably they have, there are a lot of excesses in the U.S. market, right, in terms of the money which has been, pushed into the economy, the level of interest rates, the leverage at consumer level, the leverage at government level, the leverage at state level. I don't think that's the case, with us. So bear market, I really don't think it will last for that long, just given the starting point of the price to book. Of course, there are exceptions, but given the fundamental position of a lot of companies, I mean, just name a company today which you think may go bankrupt, even if we go into a recession. You will find it very, very difficult to, find that. If you looked at 2008, you will probably, you would have had probably 100 such companies. Or if you looked at 2012-13, you would probably had, dozens of such companies. Even in 2017-18, you would have many such companies. I don't see any of those today. So, you got to keep the backdrop in your mind and, accordingly expect sort of the worst case scenario.
The biggest devil right now seems to be inflation. How is it that you inflation-proof your portfolio? What's a good strategy that you can put to work?
See, I mean, whether every, year you will have different worries. It could be inflation, it will be slow growth, it could be, any random, war or trade war or any of such things, right? You can't keep on changing your strategy, for every event that plays out. The only thing, which will stand, any kind of such disruptions is picking companies where they have significant competitive advantages, right? And those are the ones which enable them to have the pricing power. If you have the pricing power, if your input cost goes up, typically they're able to pass on those prices. Question is, whether the competitive advantages that you have evaluated, those were short-term in nature or those are sustainable in nature, right? So evaluation strategy of a company hasn't changed just because, inflation is a worry today, right? So for example, there would be chemical companies who do not have the, passing power, whereas there are certain specialty chemical companies or API companies, CRAMS companies, who have a pretty set formula. So when your input costs goes up, they'll be able to pass on, right? There are certain converters, in the steel sector who pass on, whether the steel price is at 35 rupees or 70 rupees, it doesn't matter to them. They will be able to pass on the price. So I think key is that you stick to your strategy, because this strategy has to be something which works across different risk parameters, and risks will keep on emerging. I mean, the world is become too volatile.
Okay, so do not change your strategy is the word that's coming in. Good morning, this is Nantara joining in on the conversation. I was reading an interview of yours when you had said back in the day that you really liked Nykaa's business, but you didn't invest in the IPO or apply for the IPO because the valuations didn't make sense to you. So I want to ask you, since then, there have been opportunities, the way the stock performed, it came down. Did you buy Nykaa then?
No, I mean, see, when Nykaa listed, it was at the 3x price of what I thought was the, fair value, right? So it's not anywhere close. And at the same time, what happens is, after all, it's about relative attractiveness, right? If Nykaa comes down by 50-60%, there are many companies which become even more attractive. And my rationale was that, if I invest in a regular conventional business, which is much more easy to predict, right? And where I can see doubling of earnings in the next 3 years, and accordingly, if my starting P multiple is reasonable, typically I can expect that I will double my money in 3 years. If I invest in companies like Nykaa, which are sort of new age companies, where it's very difficult to predict how they will evolve, because there is no way you can predict how the competition will evolve, given that they don't have that much of a history, my expectation of returns from such a company has to be much higher. If I'm expecting 25% return per year from a conventional businesses, I should expect much higher. So if I'm expecting 2x in 3 years, or 2x in 4 years, I should expect at least 3x, in 3 or 4 years from a company like Nykaa. And even from today's point of view, I don't see that happening. At least relatively, that outperformance is something which is very difficult to envision.
Right. Okay, so that's why you like Nykaa, but just not at this price. You still haven't found that opportunity as yet, what you consider to be a fair valuation. Now, Samit Vartak, you have time and again spoken about how you like to avoid PSUs. You don't like the regulatory overhang, the kind of returns. But would that also include a company like LIC, which most fund managers say they must have in their portfolio?
Right. See, I mean, there are certain reasons, right? So depends on your strategy, what you're looking for, right? So what we are looking for is doubling of earnings in 3 to 4 years. That's our basic requirement. And secondly, there has to be pricing power. There has to be management who is, independent thinking. A lot of those things don't exist in the PSUs. First of all, very difficult to get that growth that we're looking for. Secondly, the government has a lot of control, and they may not think just from an economic, viability perspective for a business, right? Those kind of things. So PSUs for us becomes more of timing the market. When they are really beaten down, you get in, but you got to be getting out when things start looking pretty good and things start looking pretty positive. And that's not our strategy. So irrespective of how the business is, business can be extremely strong, it can be a leader, but problem is the management. And management is in India is one of the most important factor. The execution, the control, how they strategize, all of that shouldn't be controlled by someone else.
Samit, great to speak with you today, and all I can say is I hope the market take cues from that painting right behind you and get a little inspired, but good speaking with you today.
Absolutely my pleasure. Thank you so much for having me.
Thanks.